Hello there and welcome to the Sleepy Wealth Stories. Tonight we are tracing the long and remarkable history of insurance, one of the quietest, most underestimated forces that has ever shaped human civilization. We begin not in a modern tower of glass and steel, not in a boardroom where actuaries bend over spreadsheets, but somewhere older and simpler, a clay tablet, pressed with a stylus in a river valley where two great rivers met and a merchant was about to sail downstream with everything he owned. There is a kind of promise that human beings have always made to one another, not the promise of love exactly, nor the promise of loyalty, though those are ancient too. This is a quieter promise, more practical, more mathematical in its bones, even when no mathematics existed to describe it. It is the promise that says, if something terrible happens to you, you will not face it alone. If your ship goes down, if your house burns, if you fall ill and cannot work, if your family is left without you, someone will be there. Someone will pay. That promise is what insurance has always been in every century and every form it has taken. It is easy to think of insurance as a modern invention, a product sold by large companies, governed by complex regulations, priced by algorithms that consider your age, your address, and the make of your car. But that would be to misread history entirely. Human beings have been insuring themselves against loss for as long as they have been trading and farming and sailing into uncertain waters. The instinct is older than writing, older than money, older than the nation-state. It is, perhaps, one of the most human instincts of all. What makes the history of insurance so fascinating and so quietly extraordinary is how it tracks the history of human ambition itself. Every time civilization reached outward, into new oceans, new industries, new technologies, it generated new risks. And wherever new risks appeared, someone sat down and tried to figure out how to price them, share them, and absorb their worst effects. The history of insurance is the history of what it costs to be brave. There is something else too. Insurance has always operated at the edge of what is known and what is unknown. An insurer must price a future that has not yet happened. A policyholder must pay for protection against a disaster they hope will never arrive. Both parties must trust each other, the insurer that the claim will be honest, the policyholder that the promise will be kept, and that trust, extended across centuries and continents, is itself a kind of miracle. Quiet, unremarkable, and nearly invisible, but a miracle nonetheless. And so tonight, we will travel together through time, through ancient river valleys and medieval counting houses, through the coffee houses of London and the courtrooms of Victorian England, through the wreckage of earthquakes and the aftermath of wars, all the way to the strange new risks of the digital age. Along the way, we will meet mathematicians who changed how humanity understood death, merchants who took enormous risks with borrowed money, politicians who built safety nets out of law, and companies that made promises they could barely keep. If you enjoy these gentle journeys, I invite you to like, subscribe, or share a thought below. It helps others find their way here too, one sleepy soul at a time. But for now, let your shoulders soften and your breathing slow. Let the day loosen its grip and allow your thoughts to drift back through time as we explore the long and remarkable history of insurance. Let's begin. The oldest known insurance contract was not written on paper but pressed into clay by Babylonian merchants 4,000 years ago. In the river valleys of ancient Mesopotamia, where the Tigris and Euphrates wound slowly toward the sea, trade was everything. Merchants loaded boats with grain, textiles, and precious metals and sent them south along the rivers to the ports of the Persian Gulf, and from there across open water to distant markets in the Indus Valley and beyond. The voyages were long, the waters unpredictable, and the risk of loss was total. A sunken boat meant not just the cargo but the merchant's entire livelihood, perhaps the livelihood of every family connected to his business. Somewhere in the long history of those river voyages, a solution emerged. If a merchant wanted to take a cargo to sea, he could borrow money from a wealthy investor to fund the voyage. But the terms of this loan were unusual. If the ship arrived safely, the merchant repaid the loan plus a substantial rate of interest, perhaps 20 or 30%. If the ship sank, if pirates seized the cargo, if the voyage ended in disaster, the merchant owed nothing. The investor absorbed the loss entirely. This arrangement was called a bottomry loan. The name comes from the bottom of the ship. The hull itself was the collateral. The investor was, in effect, betting that the ship would return, and the merchant was, in effect, buying peace of mind, the knowledge that a catastrophe would not destroy him. It was not quite insurance as we know it today. There was no premium paid up front, no separate insurer distinct from the lender. But the economic logic was identical. Transfer the risk of disaster from the person who cannot afford to bear it to the person who can. The Code of Hammurabi encoded one of the earliest forms of risk sharing into the laws of civilization. Around 1750 BCE, The Babylonian king Hammurabi inscribed his famous law code onto a tall black column of diorite. Most people know this code for its principle of proportional justice, an eye for an eye, a tooth for a tooth. But buried among its 282 laws are provisions that look remarkably like early insurance regulations. Merchants who lost cargo to thieves or flood were, under certain conditions, entitled to share that loss with others in a trading association. The burden would not fall on one person alone. It is worth pausing on that for a moment. The idea that law itself could mandate risk sharing, that civilized society had an obligation to prevent any one person from being destroyed by bad luck, is not a modern idea. It is 4,000 years old. Hammurabi understood something that insurance companies still sell as a concept, that a community of traders is more resilient than any individual trader, and that the rules governing how loss is shared are as important as the rules governing how profit is divided. The tablet still exists. You can see it today in the Louvre in Paris, standing in a gallery where it has stood since 1901, slightly taller than a man, its laws still legible in cuneiform script. The merchants who consulted it are long gone, their boats dissolved into silt at the bottom of rivers that no longer follow the same course. The principle they lived by, that risk could be written into law and shared among many, is still alive and still shaping the world. Sea merchants in ancient Mesopotamia invented the bottomry loan to carry the risk of ocean voyages. The bottomry loan did not stay in Mesopotamia. It traveled, as all good financial ideas eventually do, along the trade routes themselves. By the time of ancient Greece, bottomry loans were commonplace in every major port city of the Mediterranean. Athenian orators debated them in court, philosophers wrote about them. And the interest rates they commanded tell us something important. A loan for a voyage into the eastern Mediterranean might carry a rate of 22%, while a loan for a round trip to the grain ports of the Black Sea, considered more dangerous, more distant, more exposed to storm, might carry 30% or higher. That sliding scale is significant. It means merchants were already thinking about risk the way actuaries think about it today, quantifying the danger, pricing it according to probability, and letting the market set the premium. They had no statistics, no mortality tables, no regression models. They had something simpler: the accumulated experience of sailors and traders who had watched ships go out and sometimes not come back, and who had learned, generation by generation, which voyages were more likely to end in disaster. There is something beautiful in that. Long before there was a science of probability, there was a practice of it, a rough, empirical, intuitive sense of how dangerous the world was and what it was worth to be protected from that danger. The merchants of Athens and Corinth and Rhodes were not building models. They were building knowledge slowly, one voyage at a time. In ancient China, merchants divided their cargo among multiple boats to guard against the ruin of a single shipwreck. The bottomry loan was one solution to the problem of maritime risk. But in ancient China, traders along the great river systems and coastlines developed a different answer, one that required no lenders, no contracts, and no interest. They simply spread their cargo across multiple vessels. If a merchant had 100 crates of goods to send downriver, he would put 10 crates on each of 10 boats rather than all 100 on one. If one boat sank, he lost 10% of his cargo, not everything. It sounds obvious in retrospect, but it required a kind of mathematical thinking, an understanding that concentrated risk was more dangerous than distributed risk, that was not natural or intuitive. The human instinct is to keep valuable things together under one roof, under one lock. The merchant who split his cargo across 10 boats was acting against instinct, trusting in a logic that was more abstract than his anxiety. This practice, which today we call diversification, became one of the foundational principles of modern finance and insurance. The idea that risk can be made manageable not by eliminating it, but by dividing it among many, is at the heart of every insurance pool ever assembled. Thousands of policyholders, each paying a small premium, collectively absorb losses that no single one of them could survive. The Chinese river merchants understood this without ever writing it down as a principle. They simply did it because it worked. The grain temples of ancient Egypt functioned as the earliest known stores of communal insurance against hunger. Along the Nile, where the annual flood determined whether a people would eat or starve, a different kind of risk management was taking shape. The great temples of ancient Egypt served many purposes: religious, ceremonial, political. But they also served a thoroughly practical one: they stored grain. Enormous quantities of grain, gathered from the surrounding farmland during years of plenty, and held in stone repositories against the years of scarcity that the Nile's unpredictable flooding would inevitably bring. This was not precisely insurance in a financial sense. No premiums were paid, no contracts were signed, but the logic was identical. A community pools its resources in good times to protect itself in bad ones. The cost is borne collectively. The benefit flows to whoever needs it most, and the institution that manages the pool, the temple, the priest, the administrator, takes on the responsibility of ensuring that the reserves are not wasted or misappropriated. The Egyptians understood, perhaps more clearly than anyone before them, that the greatest risk in an agricultural society was not any single catastrophe, but the cumulative effect of bad years following one another before the good years could replenish what was lost. A single failed harvest could be survived. 2 or 3 in a row could not without reserves, not without a system. The grain temples were that system, the world's first social safety net, built of stone and filled with the surplus of better days. Greek merchants along the Aegean coast developed maritime loans whose interest rate rose and fell with the danger of the voyage. The Greeks were great traders and great thinkers, and when it came to maritime commerce, they were both at once. The Aegean Sea was their highway, a glittering, treacherous expanse of water that connected the city-states of the Greek mainland to the colonies of Asia Minor, the grain ports of the Black Sea, the islands of the eastern Mediterranean. Ships went out in spring and returned in autumn if they returned at all. The sea took its share every year. Greek merchants did not simply accept this risk, they priced it. The bottomry loan inherited from Mesopotamia became a sophisticated financial instrument in Greek hands. Athenian courts heard cases about maritime loans in which the details were argued with great precision. The terms of the contract, the route agreed upon, whether the captain had deviated, whether the loss was attributable to storm or to negligence or to something else entirely. The Greeks were litigious by nature, and their litigation around maritime finance produced some of the earliest documented thinking about what exactly a risk contract obliged each party to do. One of the surviving texts from this era is a speech by the orator Demosthenes, written in the 4th century BCE, about a legal dispute over a maritime loan. It reads like a modern insurance fraud case in some respects. There are accusations of deliberate shipwreck, of cargo that was claimed lost but secretly sold, of witnesses who could not agree on what had happened at sea. The details are specific and the anger is real. What it tells us is that by the time of classical Athens, maritime insurance was already old enough to have developed its own forms of abuse, its own patterns of fraud, and its own complex legal arguments. It was, in other words, a mature industry. Rome's burial clubs, called collegia, were the earliest known form of life insurance in Western history. The Romans had a problem that no amount of military discipline could solve. People died, not just in battle, which was expected, but in poverty, in old age, in the ordinary course of life in a city that was crowded and dangerous and full of people who had come from somewhere else and had left their families behind. A poor man who died in Rome might not have enough money to pay for his own burial. And in Roman culture, a proper burial, with rituals, with ceremony, with the right prayers said by the right people, was not merely a comfort. It was a moral and religious obligation. Burial club or collegium was the solution. A group of workers, tradesmen, or soldiers would pool small monthly contributions into a shared fund. When a member died, the fund paid for his funeral. Some clubs also provided payments to surviving family members. The monthly dues were the premiums. The death benefit was the claim. The club's officers were the administrators. The structure was, in every essential respect, a life insurance company. These clubs were widespread in the Roman world. We have records of burial clubs for shoemakers, for bakers, for veterans, for freedmen. We have their rules written on stone, specifying how much a member owed each month and what benefits his family could expect. One inscription from the city of Lanuvium, dating to 136 CE, lays out the terms with such precision that it could almost be mistaken for a modern policy document. The monthly premium, the waiting period before benefits could be claimed, the circumstances under which a member would be expelled and his premiums forfeited. The Romans, as in so much else, had gotten there first. Roman soldiers contributed to mutual funds that would pay a death benefit to their families if they did not return. The Roman legions operated at the edge of the known world, in forests and deserts and mountain passes where home felt very far away. A soldier who left Rome to fight in Gaul or Britannia or the deserts of Syria knew he might not return. He also knew that if he did not return, his family, his wife, his children, his elderly parents might have no one to care for them. The Roman military developed its own version of the burial club. Soldiers contributed a portion of their pay into a regimental savings fund called the depositum. Part of this served as a disciplinary measure. The money was held as a disincentive to desertion. But part of it functioned as a death benefit paid to a soldier's designated beneficiary if he died in service. The Legion itself became a kind of insurance society, its members contributing collectively to a fund that none of them hoped to need, but all of them understood was necessary. This arrangement worked partly because of something insurance companies still depend on: the large number of contributors relative to the number of claims at any given time. An individual soldier could not afford to fully self-insure against death, but a legion of 5,000 men contributing small amounts regularly could collectively accumulate funds sufficient to pay meaningful benefits to the families of those who fell. The mathematics of pooling worked even without anyone having named it mathematics. The principle was sound, and it persisted in various forms throughout the Roman imperial period. The medieval guild was more than a trade association. It was a mutual insurance society. When the Western Roman Empire fell and the elaborate systems it had built began to dissolve, the burial clubs and mutual funds went with it. Europe in the early medieval period retreated into smaller units: manors, monasteries, villages, the occasional market town. Trade contracted. Risk became more local, more personal, more bound to the land. But as trade began to revive slowly, beginning in the 9th and 10th centuries, then more rapidly as the High Middle Ages approached, the need for risk-sharing returned with it. The institution that emerged to meet this need was the guild. A guild was, on the surface, a professional association, a brotherhood of bakers or weavers or tanners, or goldsmiths organized to regulate their craft, set standards, train apprentices, and negotiate with city authorities. But beneath this professional function was something older and more fundamental. Guild members paid regular dues into a common fund. If a member's workshop burned down, the guild helped him rebuild. If he became too ill to work, the guild paid a sickness benefit. If he died, the guild paid for his funeral and provided for his widow and children. If he was traveling to a distant market and was robbed on the road, the guild might compensate part of his loss. The guild was his social safety net, his health insurer, his property insurer, and his life insurer, all in one. This multi-purpose protection was deeply embedded in medieval economic life. Joining a guild was not merely a professional decision. It was an act of mutual obligation, a promise to contribute to the welfare of your fellows and to receive their protection in return. The Latin word for this kind of mutual obligation, fraternitas, meant brotherhood. And the brotherhood was real, enforced by social pressure, by oath, by religious ceremony, and by the shared understanding that in a world without hospitals or state welfare or limited liability companies, the guild was the only institution standing between a craftsman and total ruin. When plague swept through Europe in the 14th century, the guilds discovered the limits of solidarity. In 1347, a fleet of Genoese trading ships arrived in the Sicilian port of Messina carrying something no one understood and no one could stop. Within days, people around the harbor were dying, with blackened swellings on their armpits and groin, with fever and delirium, with a speed that bewildered and terrified everyone who witnessed it. The harbor masters ordered the ships out of port. It was too late. The Black Death had arrived in Europe. Over the next 4 years, the plague killed somewhere between a third and half of Europe's entire population. Entire cities emptied. Monasteries fell silent. Harvests went unreaped because there was no one left to reap them. And the guilds, those carefully maintained mutual societies with their regular dues and their death benefits, simply could not function in the face of mortality on this scale. When half the members of a guild died within 2 years, the dues of the survivors could not possibly cover the death benefits owed to the families of everyone lost. This was a crisis of what actuaries would later call correlated risk. Insurance pools work because most disasters are local and individual. Your house burns down, your neighbor's house is fine. The pool absorbs your loss and replenishes its funds from the premiums of the unaffected many. But when the disaster is universal, when every member of the pool is exposed simultaneously to the same catastrophe, the mathematics collapse entirely. The Black Death was not a risk that any guild, any individual, any institution could truly insure against. What the plague taught Europe, a lesson that took centuries to fully absorb, was that some risks are too large and too correlated to be handled by private mutual aid. They require a different kind of intervention, governmental perhaps, or at least organized at a scale that no single profession or city or guild could manage. That lesson would not be fully acted upon for another 500 years. But it was planted there in the wreckage of the 14th century, in the empty guild halls and the unpaid death benefits and the silent workshops of a continent that had just learned, at incalculable cost, what it meant when the pool runs dry. Italian merchants in the city of Genoa wrote the first known formal insurance contract in 1347. In October of 1347, the very same autumn that the Black Death arrived in Sicily, a different kind of document was being written in the harbor city of Genoa. A merchant named Luchino Stroieti entered into an agreement with a group of investors concerning a cargo of goods to be shipped from Genoa to Majorca. The investors agreed for a fee paid up front to bear the risk of the voyage. If the ship was lost, they would reimburse the merchant. If the ship arrived safely, they kept the fee. This document, written on parchment, notarized, legally binding, is the oldest known formal insurance contract in the Western world. It is not a loan. There is no principal to be repaid, no interest accruing. It is a pure transfer of risk. You pay me a premium today, I bear your loss if the disaster occurs. The modern structure of insurance, in all its essential features, was already present in that October document from Genoa. It did not appear from nowhere. Merchants in Genoa and Venice and Florence had been experimenting with various forms of risk-sharing for decades, perhaps longer. The bottom-re loan had evolved. New instruments had been tried. Informal agreements had been made and broken and refined. But 1347 is when the formal written contract appears in the historical record, precise enough to survive in an archive, specific enough to be argued in court if either party defaulted. Insurance had, at that moment, become a legal object, something you could write down, sign your name to, and take to a judge. The bill of exchange and the insurance contract were born in the same Mediterranean counting houses, twins of a new commercial age. Medieval Italian merchant was, among other things, an inventor, not of machines or tools, but of financial instruments, documents and agreements and accounting methods that made it possible to move wealth across distances and through time in ways that had never been done before. The bill of exchange allowed a merchant to deposit money in Florence and have it paid out in London without ever touching a coin. The double entry bookkeeping system allowed him to track his assets and liabilities with a precision that earlier merchants could only dream of. And the insurance contract allowed him to send his cargo on a ship he might never see again with something approaching peace of mind. These three inventions, the bill of exchange, double entry bookkeeping, and insurance, were not separate developments. They emerged together from the same commercial culture, the same counting houses, the same families and partnerships and cities. They were solutions to the same underlying problem. How do you do business at a distance, across time, in a world of uncertainty? How do you make promises that can be enforced when the person you made them to is a week's journey away? The Italian merchants who figured this out, the Bardi, the Peruzzi, the Dattini, the Medici, were building something that did not yet have a name but that we now recognize as modern finance. They were creating brick by brick the infrastructure that would eventually allow European commerce to spread across oceans and continents, to fund voyages to places that did not yet appear on any map, and to absorb the losses that those voyages inevitably produced. Insurance was one of those bricks. Not the most glamorous, not the most celebrated, but perhaps the most necessary. Marine insurance spread from Genoa to Venice to Florence, carried by the same merchant networks that moved silk and spice. Genoa did not keep its invention to itself. Nothing in medieval Italian commerce stayed in one city for long. The merchant networks of the time were densely interconnected. A Genoese family had cousins in Venice, partners in Florence, agents in Bruges and Barcelona and Constantinople. Information traveled along these networks as naturally as cargo did. If a new financial instrument worked in Genoa, a merchant in Venice would know about it within months. By the late 14th century, marine insurance contracts were being written all across the Italian peninsula and beyond. Florence developed its own version, with its own legal customs and its own courts to adjudicate disputes. Venice, the great maritime power of the Mediterranean, adopted marine insurance enthusiastically, eventually codifying the rules governing it in a formal ordinance in 1435, one of the earliest pieces of insurance legislation in history. The Venetian Ordinance is worth noting because of what it reveals about the problems that had already emerged. It prohibited fraudulent overinsurance, the practice of insuring cargo for more than its actual value, which gave merchants a financial incentive to let their ships sink. It regulated the behavior of brokers, who by now were acting as intermediaries between merchants who wanted coverage and investors willing to provide it. It set time limits for paying claims and established penalties for those who defaulted on their obligations. In other words, within a century of its formal invention, marine insurance had already developed all the regulatory problems that still challenge insurance markets today. The invention of the printing press made it possible to standardize insurance contracts for the first time. In 1450, Johannes Gutenberg finished what he had been working on for years. The printing press in the form he gave it changed almost everything about how knowledge moved through the world, and insurance was no exception. For printing, every insurance contract had to be written out by hand, word by word. Each contract was slightly different, shaped by the particular scribe, the particular merchant, the particular city's legal customs. There was no standardization, no common language, no form that everyone understood in the same way. After printing, all of this became possible. Standardized forms could be printed in advance, with blank spaces for the specific details of each voyage: the name of the ship, the cargo, the route, the sum insured, the premium. A merchant in Antwerp could use a form that looked almost identical to one used in Barcelona, because both had been printed from the same template. Courts could apply the same legal rules to standard language they recognized, because the language was now the same everywhere it appeared. This standardization had profound consequences. It made insurance easier to sell and easier to regulate. It reduced the scope for ambiguity and fraud. It allowed markets to grow larger because buyers and sellers could transact with strangers using forms they both understood. In this modest way, a page printed with standard clauses and blank spaces for names, the printing press helped insurance scale from a local custom practiced in a few Italian port cities into a system that could eventually serve an entire world. By the 16th century, Antwerp had become the insurance capital of Northern Europe. In the 16th century, the center of European commerce shifted. The Italian cities, still rich and still important, found themselves no longer at the center of the trade routes that were reshaping the world. The voyages of Columbus and Vasco da Gama had opened new oceans. The trade routes now ran not through the Mediterranean but through the Atlantic, and the city that benefited most from this shift was Antwerp. Located on the River Scheldt in what is now Belgium, Antwerp in the first half of the 16th century was perhaps the busiest port in the world. Ships arrived from Portugal laden with spices from the East Indies. English wool merchants came to sell their cloth. German merchants from the Hanseatic cities brought copper and silver. It was, for a few decades, a city so wealthy and so busy that contemporaries struggled to find words for it. Insurance followed trade, as it always does. Antwerp developed sophisticated insurance markets, with brokers who could arrange coverage for any voyage to almost any destination. The city even passed insurance ordinances of its own, drawing on the Italian models but adapting them to local needs and to the new realities of Atlantic commerce. Voyages to the Americas were longer, more dangerous, and more uncertain than anything the Mediterranean trade had required. Pricing these new risks required new thinking, and Antwerp's merchants and brokers and underwriters were at the center of that thinking. When Antwerp's golden age ended, as golden ages always do, in this case through war and religious conflict, the insurance knowledge its merchants had accumulated did not disappear. It moved with the merchants themselves to Amsterdam and to London. Edward Lloyd's Coffee House on Tower Street in London became the most consequential gathering place in insurance history. In the 1680s, a man named Edward Lloyd opened a coffee house in the maze of streets near the Thames in London. He was not, as far as we can tell, a particularly remarkable man. He sold coffee and newspapers, which was what coffee house proprietors did. He perhaps arranged for pens and ink to be available for the convenience of his customers. He may have begun circulating a small newsletter of shipping news, arrivals, departures, losses at sea, because his customers found such information useful. His customers were merchants and shipowners, and the men who were willing, for a fee, to sign their names at the bottom of a slip of paper accepting a share of the risk if a particular ship did not return. They gathered at Lloyd's because it was convenient, because the company was good, because the information was current. Over time, the association between Lloyd's Coffee House and marine insurance became so strong that the two were inseparable. The coffee house became a market. The market became an institution. Edward Lloyd died in 1713, by which time his coffee house had already outlived its original owner and become something larger than any individual. The underwriters who gathered there, each one signing his name below the description of the risk, each one taking on a portion of the liability, had given English a new word: underwriter. To underwrite a risk is to write your name under it, to place yourself beneath it and take its weight upon yourself. The language still carries the shape of those men bending over a slip of paper in a coffee house, signing their names to risks they might have to pay for one day if the sea was unkind. The underwriters who gathered at Lloyd's invented a system of personal liability that made them simultaneously the most trusted and most vulnerable figures in trade. At Lloyd's, the underwriting was personal in a way that almost no financial commitment is today. An underwriter who accepted a share of a risk was personally liable for that share, not his company him. If a ship went down and a valid claim was presented, he paid from his own fortune. If his fortune was insufficient, he might be ruined. There was no limited liability, no corporate shield, no bankruptcy protection in the modern sense. This arrangement created extraordinary incentives for care. A man who signed his name to a risk at Lloyd's had every reason to be certain he understood that risk. He would read the description of the ship, inquire about the captain's reputation, ask about the cargo and the route and the season. He would accept only as much risk as he believed he could comfortably afford to pay in the worst case. The discipline of personal liability made Lloyd's underwriters, on the whole, thoughtful and conservative, because the alternative was ruin. But the same arrangement also created a peculiar vulnerability. When catastrophes were large enough, some underwriters could not pay. Over the centuries, there would be years at Lloyd's when natural disasters or wars produced losses so severe that some names, as the underwriters came to be called, were wiped out entirely. The principle of unlimited personal liability, which made Lloyd's credible, also made it occasionally devastating. It would take centuries of these experiences before the Lloyd's market found ways to protect itself without sacrificing the personal commitment that had always been its defining characteristic. The Great Fire of London in 1666 destroyed 13,000 homes and gave birth to the modern fire insurance industry. On the night of September 2, 1666, a fire broke out in a bakery on Pudding Lane in the city of London. By the time it was extinguished 4 days later, it had consumed more than 13,000 houses, 87 churches, and most of the medieval city. Roughly 70,000 of London's 400,000 inhabitants were left without homes. The loss was almost unimaginable in scale and almost entirely uninsured. There was no mechanism, no institution, no system for compensating people who had lost everything to fire. They simply lost everything. The Great Fire changed that. In its aftermath, a new awareness settled over London, a recognition that fire risk in a dense city of timber houses was not merely bad luck but a predictable, manageable danger. If the risk was predictable, surely it could be priced. If it could be priced, surely it could be insured. The question was only who would do it and how. The answer came quickly, as it often does when a market opportunity is large enough. Within a few years of the fire, the first fire insurance schemes began to appear in London. They were modest, often poorly organized, sometimes fraudulent, but the impulse was sound and the need was real. The Great Fire had not just destroyed property. It had demonstrated with terrible clarity that fire in a city was a communal risk, that it spread from one house to the next, that its path was unpredictable, that no individual precaution could guarantee safety. A communal risk required a communal solution. Insurance was that solution. Nicholas Barbin, the controversial London developer, founded one of the first fire insurance offices and the first fire brigades in history. Nicholas Barbin was not an easy man to admire. He was a property developer in post-fire London who built quickly and cheaply and argued, ahead of his time, that debt was not a moral failing but an economic tool. His contemporaries found him unscrupulous. He was a man who saw opportunity everywhere, including in disaster, and who did not waste much time feeling guilty about it. In 1680, Barbin founded the Fire Office, one of the earliest organized fire insurance companies in England. For a fee, Londoners could insure their buildings against the risk of fire. If a covered building burned, Barbin's office would pay to rebuild it. The insurance was genuine, and the premiums were calibrated, albeit roughly, to the risk. Brick buildings were charged a lower premium than timber ones. Buildings near water were considered safer than those in crowded streets. Barbin's most consequential innovation was practical rather than financial. His company employed its own fire brigade, men with leather buckets and hand pumps who would rush to a covered building when the alarm was raised and fight the fire before it spread. Buildings insured with the fire office were marked with a distinctive fire mark, a metal plaque fixed to the wall so that the brigade would know which buildings to save. If a building was not marked, the brigade might watch it burn. The system was self-interested and imperfect, but it worked. The fire mark is still a collectible today, oval plaques of lead and copper, some still found on old buildings in English cities, relics of the first time anyone organized a systematic response to the risk of urban fire. The astronomer Edmund Halley built the first scientific life table in 1693, turning mortality into mathematics. Edmund Halley is most famous for the comet that bears his name. He predicted its return, calculated its orbit, and was proved right, though he did not live to see the comet come back. He was a man who understood that the universe followed regular patterns, that with enough observation and enough mathematics, even the most spectacular and terrifying events could be predicted and understood. He brought the same instinct to human mortality. In 1693, Halley published a paper in the Philosophical Transactions of the Royal Society, presenting what he called a table of the degrees of mortality of mankind, a careful analysis of birth and death records from the city of Breslau in Poland. From these records, he derived what a person of any given age could expect to pay for a life annuity, a regular income stream purchased in exchange for a lump sum, paid until death. Before Halley's table, annuities were priced crudely, often at a flat rate regardless of the buyer's age, which made them a bad deal for young buyers and a good deal for old ones. Halley showed that this was wrong. A 20-year-old had many more years to live than a 60-year-old, and therefore the annuity he purchased should cost proportionally more because the seller would be paying out for longer. The mathematics was clear. The implications were enormous. For the first time, a financial product involving human life could be priced on a rational, systematic, empirical basis. Death had been turned into data. The Dutch mathematician Jan de Wit was the first person to calculate the true present value of a life annuity. In the Netherlands, a man who was better known as a statesman than as a mathematician was working on the same problem, and arriving at conclusions that were even more rigorous. Jan de Wit was the Grand Pensionary of Holland, effectively the political leader of the Dutch Republic, during one of the most turbulent periods of that nation's history. He was a brilliant administrator and a sophisticated financial thinker. He was also, in his spare hours, a mathematician of genuine ability. In 1671, de Wit submitted to the States of Holland a document analyzing the pricing of life annuities. Using what we now recognize as an early form of probability theory, he calculated the expected present value of an annuity, the mathematically correct price that a buyer should pay given their age, the prevailing interest rate, and a reasonable estimate of mortality rates. His analysis showed that the Dutch government had been selling annuities at prices that were too low, effectively giving away money to buyers and burdening the state with obligations it could not fully afford. His work was a landmark, one of the first times anyone had applied formal probabilistic reasoning to a life insurance problem and derived a mathematically defensible answer. It was also, in some ways, ahead of its time. The computational tools required to fully implement his methods would not be widely available for another generation, but the framework was there. De Wit had seen what Halley would confirm a generation later, that mortality, that most irreducible of human experiences, could be studied systematically, modeled mathematically, and used as the foundation of a rational financial market. De Wit himself died in 1672, murdered by a mob in The Hague during a political crisis. History sometimes has a grim sense of irony about the men who spend their lives trying to calculate what other men cannot foresee. The development of probability theory in the 17th century gave insurance its intellectual foundation. The 17th century was, among many other things, the century in which European thinkers figured out how to reason formally about uncertainty. Before this, risk had been a matter of judgment, of experience, of gut feeling. A merchant who chose to insure a cargo was relying on an intuitive sense of danger, shaped by experience, by the advice of others, by a rough familiarity with which voyages were more likely to go wrong. He had no formula. Correspondence between Blaise Pascal and Pierre de Fermat in 1654, a series of letters exchanged about how to divide the stakes in an interrupted gambling game, is often cited as the birth of probability theory. The problem they were solving was narrow, but the method they were developing was vast. They were showing how to reason about outcomes that had not yet occurred, how to assign numerical values to possibilities, how to make rational decisions in the face of genuine uncertainty. Jacob Bernoulli extended this work in the late 17th century, and others followed. Abraham de Moivre, who produced actuarial tables directly useful to insurance companies, Daniel Bernoulli, who introduced the concept of expected utility, Thomas Bayes, who figured out how to update probability estimates as new information arrives. Each of these contributions added a layer of mathematical scaffolding to the intuitive practice of risk sharing that merchants had been engaged in for thousands of years. Insurance was not the only beneficiary of this intellectual revolution, but it was one of the most direct and most consequential ones. By the mid-18th century, an insurance company that wanted to price its products rationally had the mathematical tools to do so, not perfectly, not infallibly, but systematically and with growing precision. The age of actuarial science had begun. The Equitable Life Assurance Society, founded in London in 1762, was the first insurance company in the world to base premiums on actuarial science. On a September day in 1762, a group of men in London signed the founding documents of a new insurance company. Its name was the Society for Equitable Assurances on Lives and Survivorships, a name so long and precise that it managed to be both reassuring and slightly alarming. They called it the Equitable for short, and the Equitable was different from anything that had come before. Its founding actuary, though the word actuary would not be fully established in its modern sense for another few decades, was a man named James Dodson, who had spent years developing mathematical tables of life expectancy. Dodson had been denied admission to an existing life insurance company because, at 46, they considered him too old to insure. Angered by this, he resolved to found a company that would price its policies correctly, charging each customer a premium that reflected the actual mathematical risk of his death at his actual age. Dodson died before the Equitable was chartered, but his ideas survived him. The The Equitable charged different premiums to buyers of different ages. It maintained reserves, money set aside from premiums to pay future claims, calculated on actuarial principles. It operated on the assumption that premiums should be priced to reflect risk as accurately as possible, not as conveniently as possible. This sounds obvious. In 1762, it was revolutionary. The Equitable became enormously successful and enormously influential. Its model premiums based on age and mortality data, reserves managed actuarially, promises backed by mathematical discipline, spread throughout Britain and eventually throughout the world. Every life insurance company that prices its policies on actuarial grounds today, which is every life insurance company in existence, is working within the framework that the Equitable established. Marine insurance underwrote the age of empire, making it possible to risk ships, soldiers, and cargo across every ocean. By the 18th century, European powers were not merely trading across oceans. They were building empires on the other side of them, colonies in the Americas, trading posts in Asia, plantations and ports and garrisons stretching from the Caribbean to the Indian subcontinent. The scale of maritime commerce had grown so large that individual merchants could no longer absorb the risk of a failed voyage. The amounts involved were simply too enormous. Insurance made this expansion possible. A merchant who wanted to ship sugar from Barbados to Bristol, or spices from the Malabar coast to Amsterdam, could insure the cargo against the risk of storm, piracy, and shipwreck. Premium, perhaps 3 or 4% of the cargo's value for a relatively safe route, was a small and predictable cost compared to the catastrophic and unpredictable loss of an entire ship. What this meant in practice was that capital could be deployed more freely and more adventurously. An investor who might hesitate to finance a single risky voyage, too much concentration of risk, too much dependence on one captain and one ship in one season, was more willing to invest in a diversified portfolio of ventures when each was insured against its individual disasters. Insurance was not just a safety net. It was a lever that amplified the flow of capital toward the frontier. It is uncomfortable to note as well that this lever was applied to the slave trade. Ships carrying enslaved Africans across the Atlantic were insured. The human beings in their holds were classified as cargo. Insurance policies were written on them. Claims were paid when enslaved people died during the crossing, sometimes, as in the case of the Zong in 1781, when they were deliberately thrown overboard so that a claim could be filed. The Zong case, which came before English courts as an insurance dispute, helped galvanize the British abolitionist movement precisely because it revealed so starkly what it meant to treat human beings as insurable property. Insurance's history, like the history of commerce generally, cannot be told without acknowledging the moral weight of what it funded. Mutual insurance companies emerged in colonial America, where Benjamin Franklin founded one of the first in 1752. In the American colonies, the need for fire insurance was acute. Colonial cities were built mostly of wood, tightly packed, and chronically short of the firefighting resources that European cities had begun to develop. A fire in Philadelphia or Boston could travel through an entire neighborhood in hours. Benjamin Franklin, who seemed constitutionally incapable of noticing a problem without also noticing how to solve it, founded the Philadelphia Contribution Ship for the insurance of houses from loss by fire in 1752. It was a mutual company, which meant that the policyholders owned it. They paid premiums into a shared fund and elected directors to manage it. If claims were low in a given year, the surplus stayed in the fund to pay future claims. No shareholders extracted profit. The purpose was simply to provide the coverage at cost. Franklin also borrowed Barbin's idea of the fire mark. Buildings insured by the contribution ship were marked with a distinctive image of 4 clasped hands, the hand in hand, cast in lead and fixed to the front wall. The company still exists today, making it the oldest continuously operating insurance company in the United States. It operates from the same city where Franklin started it, 2.5 centuries and countless fires later, still managed on mutual principles, still serving the same fundamental function, spreading the risk of loss across a community so that no single household has to bear it alone. The Lloyd's market expanded from fire and ships to cover almost any risk a merchant could name. By the mid-18th century, Lloyd's in London had evolved from a coffeehouse gathering into a sophisticated marketplace. The core business was still marine insurance, ships, cargo, voyages, but the underwriters at Lloyd's had begun to discover what every insurance market eventually discovers, that almost anything can be insured if the premium is right and the risk can be estimated. Political risk was one early addition. An investor who lent money to a foreign government or a colonial enterprise could insure against the risk of default or political upheaval, the risk that war or revolution would make the debt unpayable. Life insurance of a kind was written at Lloyd's, though it was often speculative, wealthy individuals wagering on how long a particular public figure would survive. These life wagering policies became so disreputable that Parliament eventually outlawed insuring lives in which the policyholder had no financial interest. But the broader principle that any defined risk could be quantified, priced, and transferred kept expanding. By the 19th century, Lloyd's underwriters were covering circus performers against rain on opening night, athletes against career-ending injury, and wine merchants against the failure of a particularly anticipated vintage. The market was developing its peculiar institutional genius, the ability to look at any human endeavor and find, somewhere within it, a risk worth pricing and a price worth accepting. The rise of the joint stock insurance company transformed insurance from a personal promise into a corporate product. For most of the history of insurance, the ultimate guarantee was a personal one. The Lloyd's underwriter signed his name and pledged his fortune. The mutual company's directors were responsible to their fellow policyholders. The Venetian merchant who promised to reimburse a cargo loss was personally on the hook for that promise. Insurance was, in a very direct sense, about individuals trusting individuals. The joint stock company changed this. The joint stock insurance company raised capital from shareholders, who received a share of the profits in return for accepting a share of the losses, but only up to the value of their investment. This limited liability meant that the guarantee behind an insurance policy was now corporate and finite rather than personal and unlimited. An investor in a joint stock insurer could lose his shares, but not his house, not his fortune, not everything he owned. This trade-off had advantages and disadvantages. On the advantage side, it allowed insurance companies to raise much larger amounts of capital than any individual could accumulate, allowing them to absorb much larger losses. On the disadvantage side, it reduced the direct personal commitment of those who ran the company. A Lloyd's underwriter who signed a policy and later faced a large claim was personally motivated to settle it honestly, because his own money was at stake. A corporate officer who issued policies against shareholder capital had a different relationship to that obligation, one that would, over the following centuries, produce both great reliability and, occasionally, terrible failure. Industrial accidents in the 19th century created urgent demand for forms of insurance that had never existed before. In the first decades of the 19th century, the landscape of England changed faster than it had changed in any previous era. Factories rose in cities that had been market towns a generation earlier. Railways stretched across countryside that had known only footpaths and turnpike roads. Steam engines hissed and hammered in mills and mines and shipyards, driving production at a pace that would have seemed incomprehensible to craftsmen of the previous century. And along with all of this productivity came something no one had quite anticipated at the scale it arrived: industrial injury. Workers fell into machines, boilers exploded, mine shafts collapsed. Railway accidents in the early decades of steam travel killed and maimed with a regularity that shocked the public and embarrassed the railway companies. The body was at risk in new ways, specific mechanical, industrial ways that the older categories of insurance had not been designed to address. A marine policy covered a ship and its cargo. A fire policy covered a building. What covered a man who lost his arm in a factory accident and could no longer support his family? For most of the early industrial period, the answer was nothing. Workers who were injured had no recourse against their employers under the prevailing legal doctrine. The fellow servant rule held that if your injury was caused by a fellow worker's negligence, the employer was not liable. The assumption embedded in the law was that a worker freely accepted the risks of his employment when he took the job, and that those risks were therefore his own to bear. The consequences of this assumption were visible everywhere. Injured workers in poorhouses, families destitute, children sent to work before they were old enough. The industrial economy was producing wealth on an extraordinary scale and distributing its casualties with equal efficiency. The first accident insurance policy was issued in 1864 in Hartford, Connecticut, to a man who wanted to be covered if he fell off his horse. The first personal accident insurance policy sold in the United States was, in retrospect, charmingly modest. In 1864, a man named James Batterson founded the Travelers Insurance Company in Hartford, Connecticut. His first customer purchased a policy for 2 cents, covering himself against accident for a journey of perhaps a few miles. The benefit, if he were killed, would be $200. It is easy to smile at the small scale of this beginning, but travelers recognized something important: that personal accident risk, the risk of being injured in the ordinary course of daily life, was as real and as insurable as maritime risk or fire risk. People fell off horses. They were knocked down by carriages. They tumbled from ladders and were burned by stoves and slipped on ice. These were not rare catastrophes but common mishaps, predictable in aggregate even if unpredictable for any individual. If you could estimate how often people fell off horses and how severely they were injured, you could price a policy. Travelers grew quickly, expanding into new lines of coverage as the industrial age generated new risks faster than anyone could catalog them. The company that began with a 2-cent policy for a horse ride became one of the largest insurance companies in America. Its founding moment, a man, a horse, a 2-cent premium, a $200 benefit, captures something essential about how insurance markets begin. With a specific human-scale risk priced modestly, sold to one person at a time. Life insurance in Victorian England became entangled with class, morality, and the very definition of what a man owed his family. In Victorian England, life insurance was not merely a financial product, it was a moral statement. The middle-class Victorian man who purchased a life insurance policy was demonstrating something about himself, his prudence, his responsibility, his care for his family's future, his membership in the respectable classes. To be insured was to be provident. To be uninsured was to be, at some level, irresponsible. The insurance companies of the period understood this and marketed accordingly. Their advertisements did not lead with premiums and benefits. They led with images of widows left destitute, of children sent to workhouses, of families destroyed not by wickedness but by the simple failure to plan. The message was clear and unmerciful. If you die without insurance, this is what you are doing to the people who depend on you. This moralizing tone had complex effects. On one hand, it drove enormous growth in the life insurance market. Victorian England became one of the most heavily insured societies in the world. On the other hand, it created a culture in which the insurance company was positioned as the guardian of family virtue, and in which failing to pay premiums felt like a moral failure rather than merely a financial hardship. The Victorian life insurance market was built on anxiety as much as prudence, the anxiety of a man who understood that his death could not be planned but whose financial consequences could be. The Prudential Insurance Company changed everything by sending agents door to door to collect premiums in pennies from working-class families. For most of the 19th century, life insurance in Britain was a middle-class product. The premiums were paid quarterly or annually, in amounts that assumed a degree of financial stability, a regular income, a bank account, the capacity to plan weeks or months ahead. Working-class families, living week to week on wages that left little margin for saving, could not participate. The Prudential Insurance Company, founded in London in 1848, changed this with a simple operational innovation: the industrial life policy. Agents, thousands of them, eventually visited working-class homes every week to collect tiny premiums in pennies. A policy might cost threepence a week. The benefit was modest, enough to pay for a decent funeral, perhaps a small payment to a surviving spouse. But for families who could not save in larger amounts, this was the only life insurance available, and they wanted it. The social significance of this was enormous. For the first time, life insurance reached the people who arguably needed it most, not the middle-class professional with savings and property, but the factory worker whose family had nothing to fall back on if he died before he could provide for them. The Prudential's agents became a familiar presence in working-class neighborhoods, their visits as regular as the rent collectors. They were, in a peculiar way, a link between the actuarial science of the boardroom and the anxious arithmetic of a family calculating whether they could afford threepence this week. Employers' liability insurance was born from a battle between workers and factory owners over who should bear the cost of injury. Throughout the middle decades of the 19th century, the question of industrial injury was becoming impossible to ignore. Newspapers published statistics, reform movements documented the human cost, parliamentary committees heard testimony from injured workers and from the families of those who had been killed. The doctrine that workers assumed the risk of their own employment was coming under sustained attack. In 1880, the British Parliament passed the Employers' Liability Act, which for the first time gave workers a legal right to sue their employers for injuries caused by employer negligence. It was a modest step. The law was full of exceptions and limitations, and proving negligence in court was expensive and uncertain. But it changed the legal landscape enough to create a new insurance need. Employers who had previously faced no legal liability for their workers' injuries now faced at least some. And where there is liability, there is insurance to cover it. The employer's liability insurance market emerged rapidly, companies offering policies that would cover an employer's legal costs and any damages awarded, in exchange for an annual premium. The employer transferred the financial risk of liability to the insurer. The insurer, in turn, spread it across a large pool of employers who all faced similar risks. The modern workers' compensation system, which today operates in some form in nearly every country in the world, grew directly from this moment, a law that created a liability and an insurance market that responded to it. Otto von Bismarck introduced state-mandated accident insurance in Germany in 1884, creating the template for the modern welfare state. The man who unified Germany and made it a great power was not, by most accounts, a sentimentalist. Otto von Bismarck was calculating, ruthless, and supremely pragmatic. When he introduced the world's first compulsory accident insurance program in 1884, he did it not because he loved workers, but because he recognized a political reality. The German working class was being courted by socialist movements, and socialist movements were a threat to the political order he had built. His solution was to give workers something they wanted, security, before the socialists could give it to them. The Accident Insurance Act of 1884 required employers in hazardous industries to contribute to insurance funds that would compensate workers injured on the job. 2 years later, Bismarck extended this to a broader accident insurance system, and then to old age and disability insurance as well. The German welfare state was born not from idealism, but from a chancellor's cold calculation about how to prevent revolution. The historical consequences of this are almost impossible to overstate. Bismarck had demonstrated that a government could mandate insurance coverage, require contributions from employers and workers, and administer a social safety net that private markets either could not or would not provide. His model was studied and adapted by reformers across Europe and eventually around the world. The British National Insurance Act of 1911, Franklin Roosevelt's Social Security Act of 1935, the post-war welfare states of Western Europe, the modern systems of public health insurance in dozens of countries, all of them trace a line back, however indirectly, to the unlikely figure of a conservative Prussian chancellor who decided that the best way to fight socialism was to give working people something to lose. The San Francisco earthquake of 1906 tested the insurance industry as it had never been tested before and revealed how fragile the system's promises could be. At 5:12 in the morning on April 18, 1906, an earthquake struck the coast of California near San Francisco. The shaking lasted less than a minute. The fires that followed lasted 3 days. When they were finally extinguished, more than 3,000 people were dead and 28,000 buildings had been destroyed. Half the city was rubble and ash. The insurance industry faced a reckoning. San Francisco was heavily insured. It was a wealthy city, a prosperous port, home to many business interests that had carefully obtained fire coverage. Fire policies, in theory, should have covered much of the loss, but there was a problem. The fires had been caused or at least worsened by the earthquake, and many fire insurance policies contained exclusions for losses caused by earthquake. The companies began to argue, with varying degrees of bad faith, that the fires that destroyed San Francisco were earthquake fires, not ordinary fires, and therefore not covered. The public outrage was immediate and ferocious. The insurance companies faced a choice between honoring their policies, taking enormous losses, or hiding behind a technicality that felt to most people like a betrayal. Many companies paid in full. Some did not. A few were destroyed by the scale of the losses regardless of what they intended. The earthquake of 1906 became a defining moment in American insurance history. A demonstration that catastrophe risk was real, that the concentration of risk in a single geographic area was dangerous, and that the promises written in fine print would be tested in ways that no one had fully anticipated when the policies were sold. The sinking of the Titanic in 1912 became one of the most famous insurance claims in history. On the night of April 14, 1912, the RMS Titanic struck an iceberg in the North Atlantic and sank in less than 3 hours. Of the 2,224 people aboard, more than 1,500 died. The world was stunned not only by the scale of the loss, but by the hubris that had preceded it. The ship had been called unsinkable. It sank. The Titanic was insured, though not contrary to popular myth, for its full value. The White Star Line had chosen to self-insure part of its fleet, calculating that the premium savings over time would exceed the expected losses. This was a rational decision based on reasonable probability estimates. What it did not account for was the possibility of losing one of the largest ships in the world on its maiden voyage. The insurance claims were settled through Lloyd's and a consortium of other insurers. The ship's hull was insured for £1 million, less than its construction cost. Additional claims arose from the cargo and in lawsuits that would take years to resolve from the deaths of passengers. The aftermath of the Titanic reshaped maritime safety regulation, which in turn reshaped the risk profiles that marine insurers priced. The International Convention for the Safety of Life at Sea, passed in 1914 in direct response to the disaster, required sufficient lifeboats for all passengers, regular safety drills, and continuous radio watch. These requirements reduced the risk of future catastrophic losses. The insurance market had contributed, indirectly but really, to making the seas safer. The invention of the automobile created an entirely new category of risk that the insurance industry had to learn to price from almost nothing. In 1896, a young woman named Bridget Driscoll became the first person in Britain to be killed by an automobile. She was struck by a car in the grounds of Crystal Palace in London, traveling, witnesses reported, at a tremendous speed, roughly 4 miles per hour. The coroner at her inquest said he hoped such a thing would never happen again. It was not a prediction that history would honor. Within a decade, automobiles were everywhere, noisy, unreliable, dangerous machines that shared the roads with horses and pedestrians and cyclists who had not been designed with them in mind. The accidents that followed were frequent and varied and often serious, and the insurance industry faced a genuinely novel problem. How do you price a risk that has almost no historical data? The answers came slowly and imperfectly. Early motor insurance was expensive, poorly structured, and often inadequate. The risks varied enormously depending on who was driving, where, in what vehicle, and at what speed. Building the actuarial foundation for motor insurance, the tables of accident frequency, the correlations between driver characteristics and claim rates, the pricing models that would eventually allow millions of policies to be sold at competitive premiums, took decades of accumulated experience. By the time governments began to mandate motor insurance, Britain in 1930, most American states in the following decades, the industry had learned enough to make the products workable. But the learning had been expensive. The Great Depression forced governments and insurers to rethink the relationship between the market and social safety. On October 29, 1929, the New York Stock Exchange lost 12% of its value in a single day. It was not the crash's beginning, and it was not its end. What followed was a decade of economic devastation that swept through the United States and then through the rest of the world: bank failures, unemployment, deflation, drought. By 1933, a quarter of the American workforce had no job. Families who had worked and saved and planned found that savings accounts were worthless because the banks had failed. Insurance policies were lapsing because premiums could not be paid. The system of private risk sharing that the 19th century had built was proving catastrophically inadequate. Some insurance companies failed outright. Others survived by denying claims that would have strained their reserves. The private insurance market, it became clear, could not function as a safety net for an economy that had fallen this far and this fast. A market that depends on premiums paid by people who are employed cannot serve people who have no employment and no income. The coverage was there in theory for those who had it. But the people who needed it most, the suddenly unemployed, the ruined farmers, the families of men who had lost everything, were precisely the people who no longer had it. The lesson that governments drew from this, not uniformly, not without argument, but broadly and with lasting consequences, was that some forms of social insurance could not be left entirely to the private market. Where private coverage was inadequate, government had a role. Where market failure left people unprotected against risks that no individual could absorb alone, the state could and should step in. It was Bismarck's insight, but this time it emerged not from political calculation, but from the direct, visible, and inescapable experience of an entire nation losing its footing. The Social Security Act of 1935 introduced the principle that government itself could be an insurer of last resort. Franklin Roosevelt signed the Social Security Act on August 14, 1935. The act established two major programs: old age benefits funded by a payroll tax shared between employers and workers, and unemployment insurance administered by the states but funded through a federal tax. It was, in scope and ambition, unlike anything the United States government had done before. The debates surrounding the act were intense. Critics argued that it would undermine individual initiative, create dependency, and saddle future generations with unmanageable obligations. Opponents argued that the Depression had demonstrated beyond any reasonable doubt that the market could not protect ordinary people against the ordinary risks of a working life, unemployment, disability, old age, without a public backstop. Both sides were in their own way right about something. What the Social Security Act actually created was a kind of social insurance, a mandatory participation scheme in which nearly all workers contributed premiums in the form of payroll taxes and received benefits when they reached retirement age, became disabled, or in the case of unemployment insurance, lost their jobs through no fault of their own. The language of insurance was deliberate. Roosevelt was insistent that the program be called insurance, not welfare, that it be understood as something people earned by contributing, not something given to them as charity. The distinction mattered politically, and it mattered to the people receiving the benefits. Whether Social Security is truly insurance, by the actuarial definition, is a matter that economists still debate. But as a matter of public psychology and public policy, the framing was remarkably durable. Nearly a century after its enactment, Social Security remains one of the most popular government programs in American history, partly because it is understood as something its beneficiaries paid into, as a contract between citizens and their government, as a promise that will be honored. The Second World War produced some of the most extraordinary insurance arrangements in history. When the United States entered the Second World War, the federal government faced insurance problems of a kind that had never existed before. How do you insure a merchant fleet sailing through submarine-infested waters when the actuarial tables are useless and the risk of loss is so high that no private insurer will touch it? How do you insure workers in war production plants against injuries from explosives and industrial accidents when the scale of operations is beyond anything the private market was designed to handle? The answer in many cases was government. The federal government became, during the war, an insurer of last resort on a massive scale, underwriting risks that private markets would not or could not absorb. The War Damage Corporation provided coverage for civilian property against enemy attack. The War Risk Insurance Program covered ships and cargo on routes too dangerous for private underwriters. The government, in effect, became an enormous specialized insurance company for the duration of the war. After the war, many of these programs were wound down. But the experience had demonstrated something important, that there were categories of risk, catastrophic, systemic, correlated, that the private insurance market could not handle on its own, and that a government with the power to tax and borrow could absorb losses of a scale that would bankrupt any private company. This lesson would be applied again and again in the following decades, in natural disaster programs, in nuclear energy liability, in the aftermath of terrorist attacks. After the war, employer-sponsored health insurance became the American model, an accident of history that still shapes the system today. The American system of employer-sponsored health insurance, in which most working-age Americans get their health coverage through their jobs, was not designed. It was not planned, not debated in Congress, not the result of any policy decision. It emerged from a wartime wage freeze. During World War II, the federal government imposed controls on wages to prevent inflation. Employers who wanted to attract workers in a tight labor market could not offer higher salaries, but they could offer benefits, and the government conveniently ruled that employer-provided health insurance would not count as taxable income. This created a powerful incentive for employers to offer health coverage as a substitute for wages they were not allowed to raise. Workers accepted. The system grew. By the time the wage controls ended, the employer-sponsored system was entrenched. Workers had come to expect it. Employers had organized around it. The insurance companies that provided group coverage had built their entire business models on it. When Harry Truman proposed a national health insurance program in 1945, the system of private employer-sponsored coverage was already large enough, powerful enough, and politically connected enough to resist change. The consequences of this accident of history are still being argued today. Americans pay more for health care than citizens of any other wealthy nation. They are covered by a patchwork of private employer plans, government programs like Medicare and Medicaid, and various forms of individual coverage, a system of extraordinary complexity that exists not because anyone designed it, but because it grew, layer by layer, from a wartime wage freeze and a tax ruling, and once it was large enough, it was too embedded to undo. The rise of reinsurance created an invisible global architecture beneath every policy sold. Behind every insurance company, there is another. The company that sells you a homeowner's policy or a business liability policy has typically purchased insurance of its own, a layer of protection that covers it against losses larger than it can absorb alone. This insurance for insurance companies is called reinsurance, and it operates in one of the least visible but most consequential markets in the global economy. Reinsurance works by spreading risk across a global pool that is larger than any single national insurance market. A primary insurer in Florida might seek transfer a portion of its hurricane risk to a reinsurer in Munich or Zurich or Bermuda. That reinsurer, in turn, might cede a portion of its accumulated global risks to other reinsurers in a web of contracts that, by the time it is fully drawn, spans every major economy in the world. When a major catastrophe occurs, a hurricane, an earthquake, a pandemic, the losses are absorbed not by one company or one country but by this vast distributed network. This architecture is, in a sense, the completion of the idea that the Chinese river merchants had in dividing their cargo among multiple boats, spread the risk widely enough, across enough separate entities with uncorrelated fortunes, and no single loss can destroy the system. The reinsurance market is the mechanism by which this principle is applied at global scale, quietly and visibly, largely unknown to the policyholders whose coverage it ultimately supports. The major reinsurers, Munich Re, Swiss Re, Hannover Re, General Re, are not household names. They are not supposed to be. They operate in the background, absorbing the shocks that primary insurers cannot handle, stabilizing a system that would otherwise be far more fragile. They are the shock absorbers of the global financial system, and like all shock absorbers, they are most noticeable only when they fail. The AIDS epidemic in the 1980s forced life insurers to confront a new and unknown mortality risk with no actuarial precedent. In the early 1980s, doctors in American cities began noticing something they could not explain. Young men, mostly young gay men, were dying of infections that healthy immune systems should have been able to fight off. The cases multiplied, the death toll rose, and the disease-acquired immunodeficiency syndrome, AIDS, presented the insurance industry with a challenge unlike any it had faced. There were no historical data, no mortality tables, no precedent for how rapidly the disease would spread, how many people would be infected, or how quickly they would die. Life insurers faced the possibility of enormous uncorrelated losses across a large and not easily identifiable population. They did not know who was at risk, how to price that risk, or how to manage it within their existing actuarial frameworks. The industry's response was imperfect and in some respects discriminatory. Companies began requiring HIV testing for life insurance applications in the late 1980s. They began asking questions about sexual behavior and history that were crude, invasive, and often inaccurate. They denied coverage or rated policies sharply upward for people they deemed at risk. The civil liberties concerns were real and serious. But so was the underlying actuarial problem. An insurer who could not price a risk either had to charge for the uncertainty or exit the market. HIV/AIDS also accelerated a development in insurance markets that was already underway. The securitization of life insurance risk. Some policyholders who were dying of AIDS discovered that they could sell their life insurance policies to investors for cash they needed now, discounted against the future death benefit. This practice, viatical settlement, created a secondary market for life insurance policies, with all the complexity and occasional abuse that secondary markets generate. The epidemic was a catastrophe for human beings. For the insurance industry, it was a stress test that revealed the limits of actuarial knowledge in the face of genuinely novel risk. Hurricane Andrew in 1992 caused so much damage that it nearly collapsed Florida's insurance market and triggered the invention of catastrophe bonds. On August 24, 1992, Hurricane Andrew made landfall south of Miami with winds that had not been seen in the United States in decades. It was the most destructive hurricane in American history up to that point, causing roughly $27 billion in insured losses, a number that had simply not been anticipated in the actuarial models of the companies that had written coverage in South Florida. 11 insurance companies became insolvent as a result of Andrew. Dozens more paid out claims that far exceeded anything their pricing had contemplated. The Florida insurance market nearly collapsed, with many companies deciding simply to stop writing coverage in the state altogether, leaving hundreds of thousands of homeowners without access to private coverage. The crisis forced a fundamental rethinking of how catastrophe risk could be financed. The traditional reinsurance market could absorb some of the loss, but it too had been strained. What was needed was access to a far larger pool of capital, the capital of the global financial markets, which dwarfed even the largest insurance and reinsurance pools. The answer was the catastrophe bond, a financial instrument that allowed insurance companies to transfer extreme catastrophe risk to investors in the capital markets. An investor who bought a catastrophe bond received a higher interest rate than ordinary bonds offer. In return, if a defined catastrophe occurred, a hurricane exceeding a certain strength, an earthquake above a certain magnitude, the investor lost some or all of their principal, which the insurance company used to pay claims. The cat bond was insurance in the language of finance, a risk transfer priced and traded between those who needed to shed catastrophe exposure and those willing to take it for a price. The September 11 attacks produced the largest single insurance loss in history up to that point. At 8:46 on the morning of September 11, 2001, American Airlines Flight 11 struck the North Tower of the World Trade Center in New York City. By 10:28 that morning, both towers had fallen. The Pentagon had been struck. A fourth plane had gone down in a field in Pennsylvania. Nearly 3,000 people were dead, and the insurance industry was facing a loss unlike any it had ever been asked to absorb. The total insured losses from the September 11 attacks were eventually estimated at approximately $40 billion. It was a number that would have been unimaginable as a single event loss in any previous era of insurance. Property, liability, workers' compensation, aviation, life insurance, every major line of coverage was touched. Lloyd's alone paid out billions. Individual underwriters who had signed policies on the World Trade Center found themselves facing losses that tested the limits of their capacity. The aftermath reshaped the terrorism insurance market entirely. Before September 11, terrorism was typically bundled into standard property and liability policies as an uncategorized risk, present perhaps but not specifically priced or limited. After the attacks, insurers began excluding terrorism from standard coverage or pricing it as a separate, expensive add-on. The exclusions created a market gap that the U.S. government eventually filled with the Terrorism Risk Insurance Act of 2002, which created a federal backstop for terrorism losses above a certain threshold. Another example of the government stepping in where private markets found the risk too large, too uncertain, or too correlated to price. The 2008 financial crisis revealed that a company called AIG had been insuring financial risk on a scale so vast that its failure threatened the entire global economy. In the summer of 2008, most Americans had never heard of AIG's financial products division. They would learn. The American International Group, one of the largest insurance companies in the world, had, through a small division in London, been writing a particular kind of financial insurance called credit default swaps in enormous quantities. These instruments promised to pay out if certain financial assets defaulted. In exchange, AIG received fees. The business had been enormously profitable for years. What AIG had not adequately considered was that the assets it was insuring, including vast quantities of mortgage-backed securities tied to the American housing market, were correlated risks. If the housing market fell, many of them would fail at once. And if they failed at once, AIG would owe payments to a very large number of counterparties simultaneously, in amounts that far exceeded its capacity to pay. When the housing market collapsed in 2008, that is exactly what happened. AIG faced losses so large, ultimately estimated at hundreds of billions of dollars, that it faced immediate insolvency. And because AIG had written credit default swaps for banks, pension funds, and financial institutions across the globe, its failure would have triggered failures throughout the entire financial system. The U.S. government, judging this risk to be unacceptable, intervened, providing a bailout that eventually totaled around $180 billion, the largest government rescue of a single company in American history. The AIG crisis was, in one sense, an insurance failure, but it was also something more fundamental. It was a demonstration that when an entity insures risks that are too large, too correlated, and too poorly understood, the insurance promise is not just financially unsound, it becomes a threat to everything around it. The protection that AIG offered was real only as long as the risks remained independent. When they moved together, the protection dissolved, and the losses fell instead on the taxpayers who had never signed a policy. The rise of cyber insurance in the 21st century mirrors the invention of marine insurance 5 centuries earlier. In 1997, the first cyber insurance policy was written. It was a modest instrument for a modest era, a time when the internet still felt like a novelty, when most companies had no idea what their digital assets were worth, and when a data breach meant something very different than it means today. The policy covered liability for computer-related risks. It was, at that moment, almost exactly as primitive as the first marine insurance contracts written in Genoa in 1347. The parallel is not coincidental. Both developments emerged in response to the same underlying pattern: a new form of commerce, a new form of vulnerability, and a recognition that the old categories of risk in the old insurance products did not adequately address what was actually happening. The medieval Genoese merchant sending cargo across the Mediterranean did not have a financial instrument for ocean risk because ocean risk was new. The modern company sending data across the internet did not have an adequate insurance product for cyber risk because cyber risk was new. What followed in both cases was a period of rapid, imperfect learning. Cyber insurers struggled to price risks they could not fully observe. Policyholders submitted claims for losses that policies had not been designed to cover. Courts heard disputes about whether data breaches fell under existing property coverage or required separate cyber policies. The actuarial data needed to properly price the risk were accumulating only as the losses occurred, the same slow, empirical, sometimes painful process by which the Athenian merchants had learned to price the danger of the Black Sea run. Today, the cyber insurance market is growing rapidly, driven by ransomware attacks, data breaches, and the increasing digitization of every sector of the economy. It is also struggling. The risks are large, correlated, and difficult to model. Premiums are rising sharply. Some insurers are retreating from the market. The problems that every new insurance market faces in its first generations are playing out in real time, in an industry that had not fully existed a quarter century ago. Climate change is now the central challenge of the global insurance industry, as risks that models called rare become frequent. For most of the history of insurance, the past was a reliable guide to the future. An actuary who wanted to know how often hurricanes would strike a particular coastline could study 2 centuries of hurricane records and derive a reasonably accurate probability. The future would look more or less like the past. This assumption was not perfect, but it was close enough to work. Climate change is dissolving it. In a world where the global atmosphere is warming, where sea levels are rising, where the frequency and intensity of extreme weather events is shifting in ways that historical records cannot predict, the actuarial foundation of property insurance is under stress. The past is no longer a reliable guide to the future. Events that models categorized as 1 in 100-year occurrences are happening every decade. Areas that were considered low risk are experiencing losses that their insurance premiums never contemplated. The consequences are already visible. In California, major insurers have stopped writing homeowner policies in wildfire-prone areas, leaving hundreds of thousands of homeowners to seek coverage from the state's insurer of last resort, itself financially strained and unable to adequately price the risk it is absorbing. In Florida, the private insurance market for wind and flood damage has become so stressed that many homeowners can no longer obtain affordable coverage. In parts of coastal Australia and island nations in the Pacific, some properties are simply becoming uninsurable, too exposed to rising seas and intensifying storms for any insurer to price a policy at a premium that households can pay. This is an insurance problem, but it is also something larger, a collision between the logic of insurance, which requires that risk be bounded and estimable, and a physical reality that is changing faster than any model can track. The insurance industry did not create climate change, but it is one of the first industries to feel its effects directly in the prices it cannot charge, the policies it cannot afford to write, and the promises it is struggling to keep. The future of insurance may depend on whether the industry can remain relevant while covering a world that is becoming more uncertain. Insurers have always operated at the boundary between the known and the unknown, using what they can measure about the past to make promises about a future they cannot see. This is the essential intellectual challenge of the profession, and it has never been easy. But in the early decades of the 21st century, the challenge is intensifying in ways that are testing the industry's tools and its assumptions. New technologies are creating new forms of risk faster than the industry can develop products to cover them. Artificial intelligence is making decisions that create liability without a clear human agent. Autonomous vehicles are redistributing the risk of accident in ways that existing motor insurance frameworks were not designed to handle. Genetic testing is creating data about future health risks that could transform life insurance markets, and that raises profound questions about what it means to insure a risk you can already see coming. At the same time, the social function of insurance, the promise that pooled contributions will protect individuals against losses they cannot bear alone, is under scrutiny in a world where inequality is rising, and the costs of catastrophic risk are falling increasingly on those who can least afford to absorb them. The insurance market, left to itself, will exit the markets where risk is too high or too uncertain to price. Governments will be left to fill the gaps at costs that grow heavier as the climate shifts and the technology accelerates. How this resolves, what role private insurance will play, what role governments will take, what new instruments will be invented to bridge the gaps is not yet clear. What is clear is that the fundamental human need that insurance addresses, the need for a mechanism to share risk and absorb catastrophic loss, is not diminishing. If anything, it is growing. After 4,000 years, the promise at the heart of insurance has not changed. One person agrees to carry a burden another cannot bear alone. Strip away the technology and the regulation, the actuarial models and the credit default swaps and the catastrophe bonds, and what remains is something very simple. Promise, an agreement between two parties. You pay me a small certain amount, and I will pay you a large uncertain amount if a specific disaster occurs. Everything else in the history of insurance, every innovation, every legislation, every crisis and resolution, is a variation on that single promise. It is a promise that has been honored and broken, that has been made in good faith and exploited in bad, that has been priced accurately and catastrophically wrong. It has been extended to the wealthy and denied to the poor. It has covered the cargo of empires and the households of factory workers and the life savings of retirees. It has underwritten voyages to places no European had ever been, and satellites orbiting the Earth and data stored in digital clouds. But it has never stopped being, at its core, about the asymmetry between what one person can lose and what a large group can absorb together. The Babylonian merchant who borrowed a bottomry loan against his cargo understood this. A Roman soldier who contributed to his legion's burial fund understood this. The Victorian factory worker who paid threepence a week to the Prudential's agent understood this. And the homeowner in a fire-prone California neighborhood who searches for an insurer willing to cover her house understands it today. The mathematical tools have become infinitely more sophisticated. The legal frameworks have grown enormously complex. The products have multiplied beyond any medieval merchants imagined. But the promise remains, and the need for it, the need that arises whenever any human being faces a risk too large to carry alone, remains as constant as the uncertainty that makes us reach for it in the first place. As we come to the end of our journey, you might notice how insurance feels now, not just as a product you buy and rarely think about, but as one of the oldest and most persistent forms of human cooperation. We have traveled a long way tonight. We began in the clay tablet counting houses of ancient Mesopotamia, where merchants pressed risk into law and borrowed against their cargo. We moved through the guild halls of medieval Europe, the counting houses of Renaissance Italy, the coffee houses of Georgian London. We watched mathematicians turn mortality into equations and watched governments discover that some risks were too large to leave to markets. We witnessed catastrophes that broke the system and inventions that rebuilt it. And we arrived finally here in a world of cyber threats and rising seas, where the same ancient promise is being tested in new ways. If you are still awake and you would like another slow journey through the past, there will be a next video waiting for you on the screen. You can simply let it play and keep following the thread of discovery wherever it leads. And if this episode brought you calm curiosity, you might like, subscribe, or leave a comment. It helps the channel reach more listeners who need a softer place to land. But for now, you do not need to navigate anything at all. Let your jaw unclench, let your shoulders drop. Feel your breathing find an easier rhythm in and out like a tide that knows exactly where it belongs. Imagine the last light fading behind a quiet horizon and a steady world moving forward without effort. Sleep well and good night.